The SOM rule recession indicator just hit 0.35. The trigger level is 0.50. We're 0.15 percentage points away from a mathematical signal that has correctly identified every single recession since 1950, 11 out of 11. And the 2 times it gave false signals. Recession arrived within 6 months anyway. This isn't opinion, this is mathematics. When the SOM rule hits 0.50, you're not about to enter recession. You're already in one. You've been in recession for 2 to 3 months. The signal confirms what's already happening. And right now, at 0.35, we're one bad employment report away from that trigger. Next data release, February 6th, 2026. If unemployment ticks up slightly, the SOM rule triggers. And billionaires who've been selling for months will already be positioned. Buffett with $325 billion cash, Bezos with $8.5 billion liquidated, Gates with 55% Microsoft reduction, Diamond with his first sale in 19 years. They're not waiting for 0.50. They're positioning at 0.35. Let me show you what the SOM rule is, why it's never been wrong, and why you need to position before February 6th. The SOM rule tracks the 3-month moving average of national unemployment. It compares that average to the lowest 3-month average from the previous 12 months. When current average rises 0.50 percentage points above that 12-month low, the economy is in recession. One data series, one threshold, no complex models. Created by Claudia Sahm, Federal Reserve economist, designed as automatic trigger for fiscal stimulus. The genius isn't simplicity, it's accuracy. Since 1950, 11 recessions. The SOM rule triggered during every single one, 11 out of 11. False positives, only 2. In 1959 and 1969, the SOM rule triggered, but recession wasn't immediately declared. But within 6 months, recession arrived anyway. Even false positives were just early. The rule saw recession before official recognition. December 2025, reading 0.35 percentage points. We're 0.15 points from the 0.50 trigger. Unemployment just needs slight uptick. From 4.2% to 4.35%, sustained for months, the 3-month average rises, we hit 0.50. 2 or 3 week reports, and we're there. What makes 0.35 dangerous? The distance from 0.35 to 0.50 closes quickly once it starts. When unemployment begins rising, it accelerates. Companies lay off workers. Those workers cut spending. Other companies see revenue decline, lay off more workers. Feedback loop begins. And once it begins, SOM rule triggers fast. Look at 2008. Early 2008, SOM rule around 0.30. By mid-2008, above 0.50. Transition took months. Look at 2020. COVID hit, unemployment spiked. SOM rule went from 0 to over 2.0 in 1 month. Recessions arrive suddenly. By the time SOM rule confirms, they're underway. This is why 0.35 should concern you. We're in danger zone. Next data release, February 6th, tells us if we're moving toward 0.50 or stepping back. Billionaires watch this indicator because it requires no interpretation, no debate. Below 0.50, signal off. Above 0.50, signal on, binary. Buffett doesn't guess about recession timing. He looks at SOM rule. At 0.35 and rising, risk is elevated. He positions in advance. That's why cash pile is $325 billion. Bezos sold $8.5 billion Amazon. He knows economic cycles turn, unemployment rises, SOM rule triggers, stock prices fall 30-40%. Sell high before trigger, buy low after recession confirmed. Gates reduced Microsoft 55%. Same logic. When SOM rule triggers, markets react. Gates positions before reaction. That's wealth preservation during cycles. Diamond sold JP Morgan first time in 19 years. He runs largest bank, sees unemployment data early, sees loan delinquencies rising, knows SOM rule will reflect what he sees, sells before mathematical confirmation arrives. This is the pattern. Billionaires don't wait for 0.50. They position at 0.35. By the time SOM rule triggers, too late to exit at good prices. Everyone knows recession underway. Selling pressure intensifies, prices fall, smart money already out. SOM rule rises when unemployment rises. Unemployment rises when companies stop hiring, start laying off. We're seeing both accelerate. Corporate earnings disappointing, revenue growth decelerating, margins compressing. Companies respond by cutting expenses, easiest expense, labor. Hiring freezes first, layoffs second. Tech companies leading, Meta layoffs, Amazon hiring freezes, Google cut thousands, Microsoft reduced headcount. Companies that hired aggressively now contracting, tech unemployment rising, feeding national rate. Beyond tech, broader economy showing stress. Retail companies closing stores as consumer spending weakens with savings depleting and credit card debt maxing out. Retailers respond by cutting staff, construction companies pulling back as commercial real estate crashes, and new projects evaporate. Manufacturing slowing as demand softens globally. Every sector trimming headcount in response to deteriorating fundamentals across the board. This is how SARM rule goes from 0.35 to 0.50, not through one massive layoff event, through thousands of small layoffs across hundreds of companies in dozens of industries nationwide. Unemployment rate ticks from 4.2% to 4.3%, then 4.4%, then 4.5%. 3-month moving average rises methodically. Suddenly we're at 0.50 and recession confirmed. And here's the critical point that most investors miss completely. By the time unemployment rises enough to trigger the SARM rule at 0.50, the recession has been underway for months already. Companies don't lay off workers on day one of a recession starting. They lay off workers after revenue has been declining for quarters consecutively, after they've cut other expenses first, after they've exhausted all alternatives available. Layoffs are a lagging indicator of economic stress that started much earlier in the cycle. So when SARM rule triggers at 0.50, it's confirming a recession that began 2 to 3 months prior in actual time. Economy already contracting, GDP already negative for quarters, corporate profits already falling substantially, the stock market already declining from peaks. SARM rule just provides mathematical confirmation of what's already in motion for months. This is precisely why positioning at 0.35 is absolutely critical for preservation of capital. Because if you wait for 0.50 confirmation signal, your positioning after the recession has started definitively. After markets have already fallen 15-20% from peaks, after the easy exit has closed completely. You're selling into a falling market alongside everyone else who just got the confirmation signal simultaneously. Panic selling drives prices lower rapidly. Now let me show you the timeline, because February 6th is not just another data release day. It's a critical inflection point that could determine market direction. Bureau of Labor Statistics publishes unemployment data on first Friday of every month without fail. February 6th is next release, showing January 2026 unemployment numbers. That data will update SARM rule reading and provide clarity. If January unemployment holds steady at 4.2%, SARM rule probably stays around 0.35 level. Risk remains elevated significantly, but trigger doesn't happen yet this month. If January unemployment rises to 4.3% or 4.4%, SARM rule moves closer towards 0.50 trigger point, maybe hits 0.40 or 0.45 range. Danger zone tightens considerably. And if January unemployment spikes to 4.5% or higher level, SARM rule could trigger immediately in this single reading. Recession mathematically confirmed in one data release without warning. That's the 3-scenario framework for February 6th. Scenario 1, steady. The SARM rule stays at 0.35. Risk remains elevated. Markets breathe temporarily. Scenario 2, rising. The SARM rule moves to 0.40 or 0.45. Risk intensifies. Markets begin pricing in recession probability. Scenario 3, trigger. The SARM rule hits 0.50. Recession is mathematically confirmed. Markets sell off immediately. Which scenario is most likely? Based on current trends, scenario 2 seems probable. Unemployment is ticking higher, layoffs are accelerating, hiring freezes are spreading. The January data will likely show unemployment at 4.3% or 4.4%. That pushes the SARM rule to 0.40 or 0.45. Not a trigger yet, but close enough that March or April data could push it over 0.50. And here's why that timeline matters. If the SARM rule triggers in March or April 2026, that means the recession started in December 2000. Or January 2026, which means we're either in recession right now or we entered recession within the past month. The confirmation is delayed, but the reality is current. This is the mechanism that billionaires understand. The SARM rule doesn't tell you a recession is coming, it tells you a recession is here. And by the time it tells you, the recession is already 2 to 3 months old. So if you're positioning based on the SARM rule trigger, you're 2 to 3 months late. The billionaires positioning now at 0.35 are on time. Now let me show you what happens when the SARM rule triggers, because the market reaction is predictable. When the February 6th or March data shows the SARM rule above 0.50, financial media will cover it extensively. Headlines will say, recession confirmed. Analysts will update their forecasts, investors will panic, and the selling begins. In previous recessions, when the SARM rule triggered, markets typically fell 15-25% over the following 3 to 6 months. Not immediately, gradually, as the recession deepens, as earnings disappoint, as unemployment continues rising. The SARM rule trigger is the starting gun for a process that unfolds over quarters, not days. And here's what makes this trigger so dangerous for unprepared investors. Most people don't watch the SARM rule. They watch the news, they watch the stock market, and by the time the news is covering the SARM rule trigger, by the time the market is falling, it's too late to exit at good prices. The selling pressure overwhelms the buyers, prices gap down, and retail investors are left selling at the bottom alongside everyone else who waited too long. The billionaires avoid this by exiting early. They sell at 0.35 before the trigger when markets are still near highs, when liquidity is still available, when they can exit large positions without moving prices against themselves. And then they wait. They hold cash. They watch the SARM rule trigger. They watch markets fall. And when the recession is priced in, when valuations are reasonable, they redeploy that cash at much lower prices. This is the cycle. Sell high at 0.35. Watch the trigger at 0.50. Buy low at the recession bottom. It's not complicated, it's just disciplined. And it requires paying attention to indicators like the SARM rule instead of waiting for confirmation that comes too late. What should you do? First, understand that 0.35 is not a safe level. It's 0.15 percentage points from recession confirmation. That's 1 or 2 bad employment reports away. The risk is immediate, not distant. Treat the current reading as a warning, not a comfort. Second, watch the February 6th data release. If unemployment rises, if the SARM rule moves towards 0.45 or 0.50, that's your signal to reduce equity exposure, not to panic, not to sell everything, but to reduce positions in high valuation growth stocks, in companies with weak fundamentals, in sectors that perform poorly during recessions. Third, increase cash holdings, not to zero equity, but to levels where a 30-40% market decline doesn't destroy your portfolio. If you're currently 100% stocks, consider moving to 70% stocks, 30% cash. If the SARM rule triggers and markets fall, you're protected. If it doesn't trigger and markets rise, you still participate with 70% exposure. Fourth, prepare to buy when the SARM rule triggers and markets fall, because that's when the opportunity emerges. When fear is maximum, when everyone is selling, when valuations reset to reasonable levels. The billionaires who sold at 0.35 will be buying at 0.50 and beyond after markets have fallen when assets are cheap. Fifth, don't try to time the exact bottom. The SARM rule trigger tells you when recession starts, not when it ends. Recessions typically last 6 to 18 months. Markets typically fall for months after the trigger. You don't need to buy at the absolute bottom. You just need to buy after the SARM rule confirms recession and markets have repriced significantly lower. The SARM rule just hit 0.35. The trigger is 0.50. That's 0.15 percentage points away. 1 or 2 bad employment reports, 1 or 2 months of rising unemployment, and the mathematical signal that has never been wrong, that has identified every recession since 1950, triggers again. When it triggers, the recession is already underway. You're not being warned. You're being informed of current reality. The billionaires see this. They know the SARM rule. They know what 0.35 means. They know that 0.50 is coming. And they're positioning now, before the trigger, before the confirmation, before the panic. Buffett with $325 billion cash, Bezos with $8.5 billion liquidated, Gates with 55% Microsoft reduction, Diamond with his first sale in 19 years, they're not waiting for 0.50, they're acting at 0.35. February 6th, 2026, the next unemployment report, the next SARM rule reading, that's the date that matters. That's when we find out if we're moving closer to recession confirmation or stepping back from the edge. But either way, the smart money isn't waiting to find out. They're already positioned. The question is whether you'll position with them at 0.35 or whether you'll panic with everyone else at 0.50. The math doesn't lie. The SARM rule has never been wrong. And right now, at 0.35, it's telling you that recession risk is elevated and rising. The trigger is close, the timeline is compressed, and the billionaires are already out. The only question is whether you're listening.